So we woke up this morning reading the news about residents in the UK voting in the referendum to actually exit the EU, what people have been calling Brexit. Now markets in India have fallen, equity markets have fallen globally. What does it really mean? Let's quickly look at that. So one, of course, is that this voting outcome in the referendum still does not mean that the UK is leaving the EU, yet there are several steps that need to happen. First, of course, the UK Parliament or British Parliament needs to vote on this and ratify this, and in turn go to the EU under Article 50 of the Constitution to propose the exit. But there's always a re-vote possible. We've seen enough instances in the past, including in the EU, where referendums have been held, and you've got a no vote or a yes vote, and subsequently a re-vote that's happened maybe 6 months, 1 year, 2 years later, when the deal terms have been changed, the results have been different. So that's always possible, given especially that this vote was so close. There was just a 2% difference in results. So that's always possible. And even if they go to the EU and notify the EU, it's going to take 2 years to sort of work through the steps that are required for them to exit the EU. And this 2-year framework sets the exit mechanism as well as the relationship that UK will enjoy with the EU post the separation. So we've got a while to go. But let's now look at specifically what it means for the UK and European Union itself. So I think in all of this, UK is the biggest victim, both politically as well as economically. So politically, we've seen, for example, look at Scotland. 44% of Scots have wanted to leave the UK and become, independent. That is something now that's going to gain momentum, these sort of thought processes. Economically, of course, UK runs a large current account deficit, which means it is heavily reliant on foreign inflows coming in, both portfolio inflows as well as FDI to finance the deficit that they have. And what's happening now is, of course, because of fears that foreign flows will slow down, the pound has fallen, and it could probably fall maybe 8-10% from where it was yesterday. UK stocks are down. UK stocks might not fall as much because a lot of UK companies are actually more multinational companies with very little operations in the UK but more outside the UK. Interestingly, yields on the UK government securities, which are also known as gilts, are down to about close to 1%, which is the lowest ever in history. I think what the markets are signaling is that there's a very likely chance that UK will dip into recession. But UK is still only about 3% of the global economy. I think what we need to focus on more is on what's going to happen in the EU. And I think there as well, fears have started to play out that will more countries want to leave the EU? Countries like Spain, Greece, Italy, these fears are bound to sort of play out. There will be a severe dislocation both politically and of course it will have its ramification economically, and we expect some sort of slowdown happening in the EU as well. But especially for the economies that are struggling, we expect a far more impact. For example, look at a place like Italy, where we expect yields on Italian bonds to actually start rising because most investors will start to fear that they've lent money to Italy in euros, but they might get paid back in liras, which means that they will start expecting a higher return today. And if you look at it from the Italians' perspective, they are getting punished for a crime that they actually didn't commit, and it will become a self-fulfilling prophecy. So where they could wake up and say, let's just exit the EU because anyways we're paying a higher yield, might as well pay it back in our own currency, which is lira. Now higher interest rates actually mean a slowdown in the economy and potentially recession. So that's something we need to watch out for. Let's look at India right now quickly. So, we never know how these things play out, but given where we are today, I think the impact on India is very, very marginal at this point. Just because India is largely a domestic economy, we're not dependent a lot on international trade. It's a domestic economy that drives our growth, and the domestic economy itself has actually been recovering, and we're seeing, green shoots of growth across the board. Of course, a good monsoon is something that's likely to help, and we're seeing initial signs are encouraging. On the rupee front, the current account deficit in India is almost zero, and which means we're not really dependent on foreign inflows. So the rupee also should be all right. But what we're seeing today is that the markets have actually fallen. The Nifty is down 200-300 points. The Sensex is down as well, close to 800-900 points as we speak. And to me, these are opportunities where investors should actually get in and invest, because these knee-jerk reactions create great long-term buying opportunities. Let's not forget, for example, Greece a few years back, now it really had nothing to do with India, and the markets fell. This is where the opportunities sort of come, and our view is that this is a time that you should actually take advantage of the nice rains and the monsoon that's hitting us, and actually go out for the weekend and not worry about what's happening in Europe. I think the Indian economy is doing well, and we're fairly optimistic on the equity markets. And of course, that's the reason we pulled the equity market protection in your portfolio, the put options. So there's nothing to worry about. This was exactly the kind of reasons and volatility that we want to take care of. So let's not be worried. We're doing fine.